One of the questions I was discussing with you before, if you had to put a crazy number for how much loans, how much dollar amount of loans have been made with you going like this to the paper in the last 5 years and in the last 30 years, I mean, it's a very big number.
In the last 5 years, so when I joined Affinity, they were only about a $2 billion organization, and they're now just over $3 billion.
Right.
So let's say, incremental loan growth of about $1 billion over 5 years. If I look back at my Morgan Stanley days, you start to add up 10 or 12 billion in mortgages, 15 billion in securities-based loans, probably $1 billion or $2 billion in high net worth private banking loans, and then the margin book and the trading books. You're probably talking about aggregate lending over my banking and Wall Street career north of $30 billion of
I think
lending.
it's more.
It's probably more.
Honestly, I think it's a lot more.
Yeah.
And most were good loans, right? You didn't.
Most, not all.
Yeah.
Some loans go bad, and hopefully they go bad for reasons that you didn't see at the beginning. Maybe something turn in the economy. It could be a paradigm shift in technology.
Yeah.
If you were financing the taxi cab industry and all of a sudden you meet Uber and Lyft,
Which
could be
your
disruptive.
case.
Which actually happened to both credit unions and some banks recently.
Yeah.
A technology paradigm shift like that can actually change an industry overnight. So hopefully, if loans go bad, it's not because of something you missed on the underwriting at the top of the show, but things happen to people. People go through divorce, they have medical emergencies, they have job losses, and I think credit unions, probably more so than banks, work very closely with their members to try and get them stabilized and get them back on track. I know when I came to Affinity, we had modified probably north of $100 million worth of mortgages back during the financial crisis, and I think 99% of those returned back to performing status.
So give me an example of one modified back to normal. What was it? What hiccup did it have? What did you do to fix it, and how did it get back?
Yeah, normally what we would do is, if it was a residential mortgage, we would lower the interest rate, extend the term, and put it on a 1 to 2 year modified schedule.
So give them time.
Give them time to get back on their feet and get their life back together.
And you would have to make those decisions.
Absolutely, every single modification I would review.
And you're good at that.
Well, you're good at it because you find out everybody has a story. Every loan has a story. This isn't cookie cutter or, all fits in the same box. And so you find out what the people's story is, and you work with what you have, and you try and structure transactions that are good for them, but also protect the institution. So really where you want to get to at the end of the day is a win-win situation. It's got to be good for the member borrowing from you, but it's also got to be good for the institution in terms of managing that risk.
Let me ask you, that skill of changing a loan to make it work, obviously others do it as well, you're not the only one, but you probably could assist places just with this niche in a way because you've done so many of those, right?
Yeah, absolutely. One of the we have a mortgage CUSO. A CUSO is a credit union service organization, and Affinity has one where there are 3 credit union owners, and then a 4th owner that I brought to the table is a CDFI, a Certified Development Financial Institution. They're funded by the U.S. Treasury. They focus on low-income mortgages. And a big part of what they do is credit counseling and helping people create budgets and figure out their cash flow and save up for down payment programs. And so they can afford their first home and not get in over their head. That's part of what happened in the 2008 meltdown. Anybody could get a mortgage, and there was, quite frankly, people who shouldn't have gotten a mortgage.
I remember you calling, I think loans were being made with no principal, 99%, 100%, 105%.
100%,
and you
no
said
amortization.
To me, this is a guarantee for disaster.
Well, if you think back and you look at it, I mean, it's as basic as saying, okay, if I have kind of 10 toxic mortgages and I put them in a Tiffany box with a bow around it, and it gets a AAA rating from the rating agency, that doesn't make those 10 mortgages good, right? And so I think fundamentally, you got to go back to the basics. Can the people afford this home? Do they have enough to put down? Do they have enough income to make the mortgage payments? And how's their credit score work?
How much loans total in credit union debt has been issued like just last year, given all the credit unions in America? I know.
Yeah, credit unions are still a small part of the financial landscape, but they're probably about 10% of the lending
Which is what
in America
number?
today.
What number would you say?
Boy,
What
that
number
one
billion?
yeah, I'd be hard pressed to say
But
what
it's,
they
if you
have.
guys were 3 and there was a 5, and it's probably
Well, there's some big ones. Navy Federal is the largest credit union in the country, followed by PenFed, and these are huge
$10
organizations.
billion places.
Oh, they're probably closer to 90 billion.
Wow,
in,
so this is
size.
serious.
These are sizable
Okay.
institutions.